Welcome back to the portfolio, everyone. And today we are going over the top 8 stocks you should watch this week. Like we do every single Sunday, we come out a video where we talk about different companies that are on my radar this week. All 8 of these companies this week report their earnings. And of course, when companies report earnings, there's a lot of share price volatility. And with that volatility, it may lead to some nice buying opportunities. So all 8 of these companies are nice, well-established blue chip companies. There's nothing too speculative on this list. And of course, this is a combination of both growth and dividend payers, so every investor can be interested and follow along with this list. These companies all report earnings, and what we've seen over the past couple of weeks and months is that even when strong companies report solid earnings and positive earnings, their share price within the couple days after the earnings has actually seen a decline. So that may lead to some nice buying opportunities. So if you're interested in any of these companies and you want to keep your eye on these solid companies right now for this week, and even if they report nice or solid earnings and their share price still goes down, it might be a nice opportunity to jump in, add to a position, or even create a new position in some of these holdings. So we're going to jump right into this list. Everyone, I'm the Gen Z investor, and as you know, I come out with content every single day on this channel that talks about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe. I want to get right into the list. The first stock on our list is Visa, ticker symbol V, currently trading at $195 a share. So you can take a look at Visa and you can see on the 1-year price chart, they are up 6%. So they saw those March lows and they have somewhat recovered, very close, but not up to that pre-pandemic high. Pre-pandemic high at around $213 a share. And like I said, right now around $195. They all have an insane market cap around $415 billion, making this one of the largest companies on the S&P. And of course, they do pay a dividend of $1.20 per share, which is only around a 0.61% yield. So an extremely low yield, but if we take a look at the 5-year chart, this company has seen insane price appreciation over the past 5 years. It has been growing very rapidly. And with Visa, there's actually been a decline in Visa use over the past couple months because people aren't going out as much, aren't spending as much money. So what people actually estimate for the company is that they think an 8% drop in prior years reported numbers. And of course, they think overall sales will go down around 4.7% from a year ago. So they're actually expecting, the estimates are showing Visa is actually going to see a decline in this quarter compared to last year's quarter. So it's going to be very interesting to see if how Visa stock will perform when their earnings come out, if they actually do show an improvement, or if they actually show a decline worse than what's expected. If they see a deterioration around 6 to 8% instead of around 4.7%. So Visa is going to be one I'm keeping my eye on this week. And of course, another blue chip company that I believe will operate long into the future. I don't think there's many companies that will take out Visa anytime soon. I believe their infrastructure and their innovation is going to continue to let them succeed long into the future. So that's stock number 1 on our list. For all these stocks, we talk about what people are really expecting and what we believe will happen with the earnings when they come out and how it may affect the price volatility for the shares. Stock number 2 on our list is Shopify. So of course we know the world of e-commerce has only been growing, especially it's been accelerated during the past 3 months when physical retail locations were shut down and a lot of businesses had to transition to the digital world. So Shopify, of course, is one of the main players. And of course, what they do is they operate an e-commerce website where individuals and large businesses who own and want to operate an online digital store, you go into Shopify, you pay their monthly fee, you buy some of their features, and you can build and create an online store to sell your products or services. So Shopify right now is supposed to see insane growth. Their revenue is supposed to be up around 30%. Analyst expectations are going to see a growth in revenue, but they are actually expecting a decline in earnings per share. So if we take a look, you can see here, they're expected to post a loss of 1 cent per share, which represents over 100% decline in earnings per share compared to last quarter of last year. And if we take a look, revenue is actually expected to be up to $500 million for the quarter, which is up close to 40%. So they have high expectations for revenue growth, but they're actually expected to actually lose money of 1 cent per share and have a net loss of 1 cent per share this upcoming quarter. So Shopify is, we'll see how what expectations, if they can actually post positive results per share, we'll see how that will affect the share price. But of course, if you take a look at the 5-year, Shopify has been on an absolute tear, up over 2,000%, actually close to 2,700% on the 5-year chart. Market cap only $111 billion. So once again, this is a large company. But again, all their price appreciation has been really within the last 6 months to a year. And you can see a massive surge as of late. So Shopify has been growing. The whole platform, the whole demand for Shopify has been growing. So we'll see if they can actually meet those revenue expectations of a growth of close to 38%, while they might be posting a net loss this quarter. So it'll be interesting to see how Shopify performs. The next one is another growth stock coming up at number 3 on our list to watch this week is Facebook. So currently at $230 a share, 1-year chart, they are up $12%. You take a look, see they have surpassed pre-pandemic levels where they're around $215 to $220 a share. They of course saw the March lows, but have grown and surpassed that. Not trading right at the 52-week high right now, but still towards the high side. Insane market cap at $657 billion. And of course, another growth stock here, they do not pay a dividend right now. So Facebook, of course, is in the news a lot lately. There's a lot of big, large blue chip companies are actually pulling their advertising spending away from Facebook for the next short term. So it'll be interesting to see how that really affects the company short term. Of course, Facebook generates revenue from advertisements from millions and millions of different companies where a couple of big names pulling their ads may not really affect them too much. And we'll see. We'll see if there was a lot of pullback because of the economic shutdown in Facebook ads, or we'll have to see if Facebook ads may have actually improved because of this economic shutdown where businesses were no longer spending money on physical advertisements or TV advertisements. They might have shifted over to Facebook because that's where all the attention may be during this time of need. So it'll be very interesting to see what Facebook numbers they put up, and they are one of the companies I have on my watch list this week, and they will be reporting earnings this week as well. Stock number 4 on our list, another dividend king, a solid blue chip company, PG, Procter & Gamble, currently around $125, $126 a share. You can see here, similar to Facebook, they saw the March lows but have fully recovered and up around 12% on the 1-year chart. 5-year chart up around 56%. So this is not a growth play. Of course, this is a dividend payer. They are a dividend king with an insane dividend growth history. Market cap around $311 billion and a current yield at 2.5%. On the 52-week range, they are trading very close to that 52-week high right now. So of course, if they do see a dip over this next week, this may be a beautiful buying opportunity because this is one of these solid companies that has a consistent track record of growing that dividend, and I believe will continue to grow that dividend long into the future. The next stock on our list that we have an eye on this week is, of course, Apple. They report earnings, the tech giant, one of the largest companies in the world, currently at $370 a share, up 77% this year. Those March lows were nothing for Apple. They completely surpassed and have continued to grow rapidly over the past couple of months. They've actually benefited extremely from this economic shutdown. Market cap at $1.6 trillion right now, with a yield shy of 1%, around 0.89%. So once again, Apple trading currently on the high side of the 52-week chart. If we take a look at the 1-month chart, you see they reached 52-week highs, very close to $400 a share. A little bit of a sell-off over the past week, but nothing too worrying. So if Apple reports earnings this week, and if we do see a decline with Apple, regardless if they post positive or negative earnings, once again, this is one of the most solid blue chip companies out there. I just think it could be a nice buying opportunity if we can see these shares dip down in price. Moving on, the next stock is, of course, the big bad e-commerce giant Amazon, who has been on an absolute tear as well, up 50% on the 1-year chart, currently trading at over $3,000 a share. We all know what Amazon does. We all know how they generate insane amount of revenue. They are the e-commerce giant. They make up over 40% of total e-commerce sales. This company has been dominating, and they've only been thriving and growing their business because of this economic shutdown. Their market share has only been growing. This company is dominating right now. There's nothing more to say. This is a company that so many of the big institutional investors, some of the billionaires that you see on TV all the time, are huge fans of. Example, Mark Cuban always likes talking about the market, billionaire investor. He owns over $1 billion worth of Amazon stock. He's a strong believer in the company and the growth that this company can actually achieve. So if Amazon, of course, if we can get a dip in on Amazon, if they post positive results, which I'm sure they will, it'll be very interesting to see what's going to happen with their price, not only within the next week, but over the next coming months and years with our new transition to a more digital presence and a lot of people spending more time shopping online and less time going to physical retailers. Stock number 7 on our list, of course, the next tech giant. So of course, all the tech giants really are posting their earnings this week, which would be interesting to see. Google, the company where even Amazon and Apple, they know that Google is a beast and they actually aren't even trying to beat Google. They're just trying to stay with it. They know Google is extremely innovative and they're doing so many great things of growing not only revenues, but just changing the world, innovative products that are changing the way people live their lives. And of course, even the other big tech players respect Google as their competition and know that it is just a beast that they have to keep an eye on. So Google is around $1,500 a share right now. Once again, another growth stock on this list. A lot of these tech companies don't pay a dividend just yet. focus on that growth and focus on reinvesting as much money back into the business. So Google's up 32% on the 1-year chart, once again surpassing pre-pandemic levels, very close to the high side on the 52-week range, and a market cap at over $1 trillion. So once again, an insane company, over $1 trillion market cap, and of course, I don't believe Google's going anywhere anytime soon. Their infrastructure is so strong. They have diversified revenues. What they're doing overall as a company and continuing to grow and how they actually run their business is beautiful. They have some of the strongest financial statements out there. Google is just a beast. And of course, if you can get into any of these tech companies on a nice dip, it may succeed and may do very well for investors over the next coming years. 5, 10 plus years, I don't think Google is going anywhere anytime soon. And the 8th and final stock on our list is actually not a tech company anymore. Of course, we went through a bunch of tech companies, is McDonald's. This company is currently trading at $192 a share. You can see here, finally we see a little bit of red. On the 1-year chart, they're only down around 6.6%, so nothing too worrying. 52-week range, they're trading on the high side, but not directly at that all-time high. Market cap of $147 billion with a yield of 2.5%. So we're back to another dividend payer. McDonald's, of course, pays a nice dividend that they've been growing for a decent amount of time. If we take a look at the dividend tab here when it loads up, you can see that they have a growing dividend for 43 years. That is absolutely remarkable. So, of course, they are a dividend aristocrat. They are working their way towards becoming a dividend king at that 50-year mark. Payout ratio 86% is extremely high right now, which they do need to work on getting that down. And overall, though, they've been growing that dividend at a rate of 7.6%, which is perfect. When you have a nice 2.5 yield, you want your dividend growth rate to be between 5 and 10% at least. And if that is great range, they are directly in the middle of that. So McDonald's has seen a little bit declining revenue year over year. So it's an interesting play right now. But if you believe in the company, if you really believe in their strong real estate assets to go along with, of course, their revenue from their food services, this company may be a nice buy right now. You can get in at a 2.5% yield, so not too shabby yield. The company's done a beautiful job of growing their dividend year over year. And I believe that with this company, just the foundation they have behind it and the strong real estate assets, I don't believe they're going anywhere anytime soon. I really don't believe McDonald's is going to, even though their revenues may be declining, they are coming out with different products to get those back up. I don't think there's anyone out there that can really knock off McDonald's. They have over 35,000 locations across the globe. It's going to be very tough to knock this company and completely take it off the map anytime soon. So overall, those are the 8 stocks you can take a look at this week. I have all 8 of them on my watch list. I do believe they are strong companies that are going to report earnings. And once again, if I can get in on a nice dip and a nice buying opportunity, I will absolutely do so. So thank you everyone for tuning in. Those are the 8 stocks to watch this week. Like I said, I post videos every single day on this channel. So please like and subscribe, and I will see you in tomorrow's video.